Associate Professor Jamus.
Those of us who have traveled or lived in the United States may be aware that if we open a bank or credit card statement and we notice an unrecognized transaction, we would simply call the financial institution, report the incident, and in most instances, the customer service officer will eventually remove the errant transaction, often after some investigation. I used to view this as an anomalous luxury, the sort of social-cultural exceptionalism that only a global financial superpower like the United States would be able to conjure. But I now understand that much like the ability to return goods, no questions asked, within a stipulated time frame, or the ability to access long-term, fixed-term mortgages, that these features of economic life result from regulatory and legislative choices that the US has chosen. Indeed, many other OECD economies have weaved together laws and regulations that afford much more financial protection for the average consumer than we have been able to muster. Madam Deputy Speaker, the Financial Services and Markets Bill of 2022 brings together a host of hitherto disparate financial sector requirements that fall under the Monetary Authority of Singapore into a single piece of legislation. Such consolidation is welcome, of course, not least because it renders transparent the full scope of rules and regulations that MAS oversees. The Omnibus Bill is wide-ranging and touches on matters as diverse as anti-money laundering and combating financing of terrorism provisions, requirements for technology risk management, and statutory protection for financial dispute resolution agents. While I support the bill, I will focus my remarks on Part 5, which have to do with technology risk management. I will do so through the lens of the consumer, and in particular, consumer protection. Before I proceed, I declare that I am the Chief Economist Emeritus of a wealth management advisory outfit. Banking-related fraud is pervasive in Singapore. In 2020, there were 893 reported cases of banking-related phishing activities costing victims at least $3.3 million. And in the first half of 2021, excluding the $13.7 million loss from the OCBC episode, already 535 cases were reported, tallying at least 2.1 million. The number of scam cases have steadily risen, and this trend is unlikely to retreat. I'm certain that many of us have had residents come to us for help with banking scams. For the recent OCBC phishing scam alone, I had 2 different residents reach out to me. The scams had wiped out their life savings. And I felt helpless, perhaps as helpless, no, I stand corrected, not as helpless as they did, but I certainly felt helpless that I could not offer more than to reach out to the banking institutions to share their side of the story, reassure them that the police were working on resolving their case, and offer to follow up with agencies that they felt were not being responsive. But I could not tell them that Parliament was working to better protect them and others like them with the specific force of law. As online services become increasingly the norm in Singapore, the opportunities and incentives for bad actors will increase. While banking scams are impossible to completely eradicate, we can better manage the acceptable level of risk. But our legislative efforts have largely been cautionary, by encouraging individuals to exercise appropriate cyber hygiene, as if we needed another type of hygiene situation to worry about, or reactive, when the police force is mostly left with belated attempts to track down and apprehend perpetrators, many of whom will never ever be found or fall beyond the reach of our current laws. The banking sector to date has appealed to the viability of self-regulation, and indeed, on paper, some of these additional protections may have helped prevent some instances of fraud had they been operative, but many were not. As I shared with this House, in February, my Sengkang colleague, Louis Chua, and I conducted a simple experiment where we tested PayNow safeguards by transferring sums in excess of $1,000, the stated maximum daily transfer limit allowed, without requiring token authentication. As I shared then, we were able to do so without any two-factor authentication beyond the PIN. We've since repeated the experiment. All good science must, after all, be replicable. And I can confirm that we were still able to breach the stated limits without a token. Madam Deputy Speaker, Part 9 of the bill exhaustively deals with aspects of digital token service providers. However, even the most finely tuned stipulations will be of limited efficacy if the tokens themselves are not deployed as intended. Moreover, lapses of this nature are not isolated. Another customer shared about how her mother's credit card limit was breached almost by 2 times without any alert or credit line being frozen. I've had residents share with me about how, after they had inadvertently released their banking information to the scammer, they realized their mistake and, within the following hour, called the bank to request forfeiting of further transactions. But the long hold times and, ironically, security verification procedures meant that the fraudulent transfers took place in the interim. As experts in the financial world, banks and their staff hold a duty of care to their customers. They hold far greater knowledge of the inner workings of illegal modus operandi, money mules, laundering, impersonation, scam rings, than the average customer. Moreover, they have access to the customer's banking history, which can be used to detect anomalies or deviations in their regular behavior. Scams and phishing operations have grown so sophisticated that the average layperson, not to mention those who are not comfortable with technology, cannot always be reasonably expected to routinely identify and proactively avoid them. To be fair, such due diligence is already exercised in limited form today, which means that it is clearly doable. Software-led detection of anomalous transactions has been employed by American credit card companies for decades. More recent advances in big data and machine learning have refined such techniques even further. These have been deployed to help thwart scam attempts, even here. But absent stricter legislative consequences that would spread the costs of breaches and establish a minimum standard of care for retail banking customers, the effects of the inevitable lapses will continue to be borne mainly by the end user. This still leaves enormous leeway for how banks currently choose to handle scam cases, with very limited recourse for the consumer. As a nation, we have never shied away from complementing regulation with legislation. It's little reason for us to revise this now. In principle, the government has already tools that enforce greater discipline on banks to ensure that consumers are better protected. But there are reasons why the banking regulator, the MAS, has been a little more reactive than proactive. First, banking regulation is but one of many, many hats the MAS wears. The MAS is simultaneously the lender of last resort, the banker to the government, guardian of inflation, executor of exchange rate policy, promoter of financial development, overseer of financial stability, and financial sector regulator. Now, setting aside how such a multiplicity of objectives may occasionally come into conflict, the many objectives make it difficult for a single regulator to monitor and ensure coherence between them. Second, in its efforts to foster greater financial sector development, the MAS may be more comfortable with allowing banks to experiment with innovations. Now, this is not an issue on its face, but the risk is that the costs of such innovations end up being disproportionately borne by the end user. Admittedly, sponsoring banking innovation and entrepreneurship requires some degree of regulatory forbearance. But by the same token, this may in turn foster an aversion toward excessive or overzealous enforcement. Third, the proof of the pudding truly is in the eating. MAS has not always appeared to be aware of the blind spots, or if it has been reticent to act quickly and decisively. In the recent OCBC fiasco, MAS only announced possible supervisory actions against the bank well after the fact, and in the wake of a public outcry over the matter. And despite well-known security vulnerabilities associated with SMS technology, MES has continued to permit its use for sensitive functions such as OTPs or requesting information from customers, and has only advocated the removal of clickable links thus far. Now, even if we wish for MES to retain overall oversight responsibility over the financial sector, as implied by the consolidations weaved into this bill, it is still reasonable to have an independent consumer financial protection arm operating within the broader ambit of MES. The financial protection arm would receive complaints from the public on consumer finance, such as deposits, mortgages, credit cards, and auto and education loans. It would also examine compliance with regulation from the endpoint of the end user. In this manner, we have distinct departments addressing concerns raised by the consumer and the producer, which in this case is the banking sector. A Chinese wall would then shield this body from the various prudential supervision departments. In the past, there was a market and business conduct department, which ostensibly served the, and I quote, interests of depositors, investors, and policyholders. This may have since been enfolded into the corporate finance and consumer department. In either case, however, these appear to work more with market professionals and possibly sophisticated investors rather than the retail consumer. Nor does the department appear to be empowered to advocate on behalf of the consumer. But we can go beyond regulation, even the beefed-up kind that I have suggested, to introduce outright consumer financial protection legislation. This can be independent of existing regulatory and consumer education efforts. Some see regulation and legislation as essentially two sides of the same coin. At risk of sounding pedantic, this is a distinction with a difference. Regulation is a function of government agencies and the domain of bureaucrats, while legislation is debated, deliberated, and realized in this House. Regulation has one clear advantage over legislation. Because it falls under the purview of a government agency, in this case the MES, it does not have to undergo the bill's process, and it therefore can be more nimble than full-bore legislation. But by the same token, however, codifying essential principles into legislation enshrines the doctrines that we wish to remain inerrant and allows them to remain invariant to the vagaries of specific implementation. Just as important, laws embed the democratic process in a way that regulatory machinations never quite can. Many other jurisdictions have specific consumer protection laws. In the United States, the Fair Credit Billing Act was enacted as far back as 1974 and requires prompt written acknowledgement of billing disputes and the investigation of billing errors by creditors. In 2010, the Consumer Financial Protection Act was passed, establishing an independent agency within the Federal Reserve to regulate the offering and provision of consumer financial products. The United Kingdom Consumer Credit Act provides a number of comparable protections, and in the European Union, the revised Directive on Payment Services encapsulates a number of regulations governing financial services providers, including requiring strong customer authentication for the majority of electronic payments. Implementing legislation for stronger consumer protection does not absolve individuals of the responsibility to practice good cyber hygiene. But at the very least, it will shift the burden of defending against such unscrupulous behavior away from resting almost entirely on the shoulders of the household and bring businesses, and in particular banks, into the risk-sharing picture as well. Back in January, MES announced a framework for the equitable sharing of losses arising from scams. This is surely welcome and will provide additional clarity on apportioning fraud-related losses. But the framework is far from comprehensive and does not yet address aspects of consumer protection that go beyond scams. And just as we do not rely solely on mediation mechanisms such as TADIM or TAFEP to fully govern our labor disputes, we can further support consumer rights in finance with appropriate legislation. If the experience of the United States is any indication, passing a consumer financial protection law itself would likely lead to financial institutions taking much more care to detect and preemptively stamp out instances of phishing and fraud, since losses cannot be immediately foisted off to the customer. Financial institutions would also be more inclined to pursue unauthorized purchases with the merchants, and these merchants, in turn, would be more careful in accepting potentially fraudulent payments, else they lose their right to accept that mode of payment. Rudimentary small claims insurance schemes would also emerge, with costs often absorbed by the financial institutions themselves. Would this increase the cost of doing business? Of course. But the point is that the cost of policing e-commerce fraud and theft was always there. It was simply absorbed almost entirely by the consumer. Such a law would spread the risk among all actors in the economy: the buyer, the seller, and the financial intermediary. It is an idea whose time has come.